Hello, everyone. Thank you so much for joining here on our 2026 Market Outlook. Today, we're going to cover a number of different things, but before showing the agenda here, I just wanted to share that we're going to start everybody off on mute just to maintain the audio for us. But at any time, you can include or ask a question in the comments. So it's usually on the toolbar where you can ask a question, and we'll try to answer during the presentation, but we'll also have some time at the end to share any questions that came up or some repetitive questions that came up and make sure to answer those for you. So today we're going to cover for our agenda is we're going to recap 2025, how the markets reacted to a number of different geopolitical and economic news. Then we're going to dive into with Cade Johnson, our analyst, and Thomas Jenkins, cover what we're seeing, both opportunities as well as the risks, and where we see some opportunities to invest and some areas to avoid. And then we're going to summarize and then have a couple of updates here as well for on the tax side of things with that one big, beautiful bill that was passed in July of this past year. But before diving into all that, I wanted to share a couple of updates for you. So since going independent almost 3 years ago, the goal has always been and hopefully will always be to make sure to constantly improve the services, the offerings, and the talent available to you as clients. And so a couple updates from last year here. We had three folks join us officially. So Thomas Jenkins and Deanna Renz joined us from Wells Fargo Advisors. I worked with them previously when we were at Wells Fargo Advisors. And then Laura Douglas will be our pair planner, another additional pair planner here available for you as clients to reach out to in case one of us is busy. Along with that, so with Thomas joining, one of the key areas that he's been focusing on is on the philanthropic services side of things. So Thomas has a designation chartered advisor in philanthropy. And so I'll be able to expand the offering for clients that are involved with nonprofit associations, foundations that are looking to get some consulting both on the governance side as well as their investment policy statements. Another big update coming soon, probably after tax time, is that we will be adding Charles Schwab as a custodial option for our clients. So no recommended changes at this time for many folks, but one of the things that we're constantly trying to do is trying to find opportunities for different investment styles or access to different things. And so for a number of clients, we identified some opportunities where Schwab might be a good alternative compared to Trade PMR and First Clearing, but no major changes, just another tool in the toolbox that your advisors will have to be able to serve you and your family. Another update as far as the product side of things is Trade PMR's association with a company called Robinhood. Started a number of years ago, it was mainly as a trading app online, and they recently acquired Trade PMR, who was our back office. And so again, no real change for folks day to day, but there is Robinhood has been building out their banking services, particularly on their credit card and their mortgages that I've been testing out myself personally, and it's a very neat newer technology and service and offering on the credit card side of things. So currently, if you wanted to get access to it, there's about a 3 million person wait list, but because of that partnership, in case you do have a Robinhood account or are interested in their banking services, we can accelerate and skip the line for our clients. So if you're looking to enhance that banking side, let your advisor know, and we'll get you ahead of everyone else. And then just as a reminder, we don't get compensated on any of that. That's just purely in addition to a couple other big news. So on January 2nd, we acquired Lifestyle Tax and Accounting up in Maple Grove, and we'll be bringing on the full team there based off of some of the demand and some of the pipeline for some of our tax services. So we wanted to accelerate that. We're pretty topped out for 2025, unless there's emergency. Happy to help families we serve on the tax needs. But that's really going to help expand for 2026 tax year. So more to come on that, likely later this summer. Along with that, we'll also have a Petros Family Wealth office up in Maple Grove, connected to the Petros Family Tax second office up there as well. And that tentatively should be completed around March 1st. So if you have some folks that you need to meet, and it's easier for you to meet in Maple Grove versus Bloomington, we'll have that option available to you as well. So along with that, I'm going to pass it on to the main event here with Cade Johnson and Thomas Jenkins, and they'll cover here for what happened in 2025 and what we're thinking for 2026.
Awesome. Thanks, Carl, and hello, everyone. Thank you for joining and tuning in. I first wanted to cover 2025, recap what happened a little bit, given it was a very eventful year, and have some takeaways that we can look forward to for our 2026 outlook. 2025 was an extraordinary year across almost all global asset classes. The MSCI All Country World Index is our broad-based gauge of how the global market is performing. It's primarily a mix of US stocks with some international exposure mixed in, and that index was up 22.87% last year. If we split that out into separate buckets, the S&P 500, which includes US large cap stocks and 500 of the largest publicly traded companies in the US, managed a 17.88% return on the year. But look at international. One of, if not the biggest surprise of 2025, the MSCI EFA index managed its best return since 2003. Emerging markets had an amazing year as well, its best since 2017. Bonds provided a solid return above inflation. And last but certainly not least, gold, yes, the commodity, provided the best return since 1979 with a 62% gain and nearly doubled the returns of any asset class shown in this group above. Moving over to the sector returns in the US markets, given we're in the midst of a bull market, in our opinion, the growthier sectors have generally outperformed the more defensive sectors once again. Technology leading the pack with AI being the central story in 2025. Communication services had another great year, led by Google. Industrials and utilities were two huge beneficiaries of AI spending as data center and infrastructure companies continue to be built out. More defensive sectors such as real estate and consumer staples had muted gains on the year. You can see every sector was positive for 2025. And when we zoom out over the last 3 years, the S&P has produced 15% or more gains consecutively. Very impressive performance and consistent with a bull market. Now, these gains have, specifically in 2025, have come with consistent pessimism throughout the year. This chart shows consumer sentiment over the last 10 years and how Americans generally feel about the overall economy. A decline in the chart would be consistent with a more negative outlook, and that's exactly what happened in 2025 in that red shaded region. Consumer sentiment is in the gutters and has fallen sharply since January of last year. Much of this can be attributed to the tariffs imposed in April, which created mass uncertainty, and uncertainty is the kryptonite for financial markets. But since then, the S&P 500 is up over 30%, while sentiment is now sitting below where we were in April. And that's why investors are calling this one of the most hated stock market rallies we've ever seen. So with last year in the rear view, our outlook for 2026 is split into two halves. For the first half, we're expecting market volatility, potentially stemming from uncertainty in monetary and trade policy, valuation concerns, and an increasingly concerning labor market. For the second half, though, we're expecting a recovery later in the year with higher confidence as we approach year end. Overall, while we view the first half and even the middle of the year as potentially murky, we still see the S&P 500 eking out a single-digit gain for 2026. Now I'll pass it over to my colleague Thomas to talk about some of the opportunities we foresee in this year.
Thanks, Kate. And also thanks, Carl, and everyone. Super excited to be here and have this opportunity. Happy to see we've got quite a bit of folks joining today. And so, yeah, I'm going to cover what we see as far as opportunities in financial markets for this year. And to do that, I think the best way is to look at, historical kind of references because, while things don't always repeat themselves, a lot of times in markets we see things that rhyme. So what we've done here is we take a look back at, all years in the S&P 500 since 1931, and specifically what we're trying to look at, because 2026 is a midterm election year, is how did markets return in those years? And so The dark colored line would be all normal years. Okay, we typically kind of see a start, you go up a bit around the holiday season, things pull back, finish strong, with an average return of any given year about 9%. In midterm election years, we typically will see a lot of chop and some uncertainty. And going into, and once we hit that midterm election, then we typically see a nice recovery. And while that average return is about 6%, which is less than the average, it's coming, gives us a nice framework of what to expect as far as throughout the year of how markets and how things folks behave in markets. And so, looking here, should we expect a recovery like this in 2026? There's several things that are compelling as far as a tailwind that makes sense structurally. And so other opportunities is since 1939, there's been 21 midterm election years. And after every midterm, through June 30th of the following year, S&P 500 was positive 21 of 21 of those times. So that's a really strong win ratio. So that's why we think that a year in a rally makes a lot of sense given that context. Additionally, this year, a lot of us, and a lot of clients, we've been discussing quite a bit about AI. AI is the hot new thing. And while we believe it's here to stay, what we've seen in markets in 2025 was kind of, wait a minute, all of this extra spending and growth, is this going to actually equate to increase earnings and increase productivity? And so, looking at certain individual companies in 2025, an example would be C.H. Robinson. Many of you know C.H. Robinson, local company, logistics company. They deployed AI software to proactively manage shipments, optimize routes, provide accurate ETAs, and that stock was up over 50% in 2025. Other names like Lowe's has been doing the same. Basically, every part of our daily lives, AI is starting to become more and more common. The challenge from an investment standpoint becomes you have to spend and take that risk ahead of time. And then at some point, investors take a look at that and say, wait a minute, all this has been done. When are we actually going to see the results? And so we see this as actually an opportunity. Because of this AI spin and AI growth, other areas in the market have kind of been ignored and looked away. And so we expect that 2026 is going to be what we would call a show me year for AI. Investors are looking at it to say, are those earnings growth and is that tangible data going to start coming in for this amount of investing that's been happening? And therefore, we also see that because of that, it's likely that other sectors that have not been getting that attention is going to start getting more attention, which is a good thing for markets. We want that growth to spread out. We would much rather have a more predictable and average instead of a lot of uncertainty and spikes. It's fun to get a nice spike, but from a planning perspective, we want to make sure we're looking right down the middle of the lane there. So on this next slide, we're going to also cover, additional opportunities that kind of support this thesis as well. So far we've covered the average midterm election year and how the S&P 500 has performed, what happened in 25 with AI and where we think that's going to happen in 26. So right here, we're looking at the profit growth in 2025, 24, and 26 for each sector in the S&P 500. And you can see that all sectors are projecting to have growth, with technology and materials leading the way there. So tech has led the momentum for the last couple of years, but it's now showing to start to kind of slow that growth and that momentum, which aligns with the idea of show me the proof of where the AI growth is going to happen. So in our view, the broader market is going to contribute to that earnings story. Every sector here is expected to increase its earnings for the first time since 2018. If we get this earnings growth, even investors that are really focused on AI-centric type investing are very likely to pivot to other stories in other sectors. And so that's healthy in the long run. Another aspect that's happening this year as well that aligns pretty closely with midterm elections is going to be a new Fed chair. And so right now we're in an interest rate kind of reducing environment. We know that the current chair, Jay Powell, his term ends in May, and the new nominee is expected to be announced sometime soon. And we believe that the administration that we have right now is very likely to nominate someone that aligns with this administration's views of lower interest rates. And so lower interest rates is typically very bullish for equities, for businesses. The cost of borrowing to invest and grow comes down. So with inflation now under 3% and unemployment ticking up, it's very likely that the new Fed composition is going to be really data dependent and look to lower rates even further. And so we see this type of easing policy as a positive for businesses and capital spending, and it just happens to line up right in the time where we look at that rhyming of midterm election years. So in terms of rate cuts, when we and I love this type of research because again, we like to look back and see how did things happen with these types of circumstances lining up. So when in terms of rate cuts, we see directionally positive for S&P 500 when rates cuts occur near all-time highs. And we are at an all-time high right now. So this table shows all the instances since 1970 where the Federal Reserve reduced interest rates while the S&P 500 was within 1% of all-time highs. In those 14 instances, the S&P was positive a year after those rate cuts with an average return of 15%, as shown in the far right table. So on December 10th, 2025, the Fed cut interest rates again, and we think it's reasonable to expect the S&P 500 should be higher by December in this year. But a 15% return coming off, after following 3 back-to-back years, double-digit returns, it seems lofty. And so that supports kind of where we see things throughout the year, the sectors and such that we'd like to focus on. We don't want to get over our skis. And honestly, I'd much rather have a more muted and calm year to continue to support the following years of positive bull markets than to, have a really, another bang out year of double digits. And so with that, I'll pass it back over to Kate.
Awesome. Thank you, Thomas. So with the opportunities in mind, let's take a look at the major risks that we potentially see shaping markets heading into this year. For context, Thomas talked a little bit about the midterm years. It's historically the weakest for stocks in the election cycle. This chart shows performance of the S&P split out by election cycle years 1 through 4. For example, 2025 would fall into the year 1 bucket. We're now in year 2, which shows a 3.3% return on average in the dark blue bar in that red region. Midterm years often see the largest sell-offs as well, with an average pullback of about 17.5% since 1950. So for context, the sell-off from the tariff uncertainty in last year in April was about 18.9% for the S&P 500. So historically, we don't think it's unreasonable for us to see a similar pullback, either for similar or different reasons. A second risk we see is the expected returns given where current valuations stand today. A lot of people in the financial space are talking about a bubble, and usually when I hear the word bubble, it's synonymous with high asset prices and high valuations, right? This chart shows us those expected returns of the S&P 500 over the next 5 years, given current valuations as measured by the price to earnings or PE ratio. Why is that PE so high? And you can see that we're currently in the high valuation range on that x-axis, with markets averaging a return over the next 5 years of about 0 to 1% per year. So why is it so high? It's being driven by the high concentration of growth stocks at the top of the S&P 500, which most of them have a pretty inflated PE, which in turn is going to inflate the valuation of the index itself. If you put $100 into the S&P 500 fund right now, which is supposed to buy you a fraction of 500 companies, right? In reality, 35 to 40 of those $100 are going to just 10 of the 500 companies. And essentially, you're paying a premium for a lot of these companies as well, and PE is not an infinitely expanding ratio, right? Historically, there's some mean reversion going on there, as shown in this chart. So we'll be keeping this in mind to see if valuations do really stretch or retract in this year. A third risk stems from the tariffs imposed starting in April and the fallout from then. They were enacted under the International Emergency Economic Powers Act from 1977, but now multiple businesses have launched cases against the administration's tariffs. A decision is expected to be made early this year by the Supreme Court, and if tariffs are struck down, they could actually provide refunds for a lot of those businesses. However, we view this as a negative overall. If the Supreme Court rules them unconstitutional, in our view, it's likely that tariffs will not go away entirely and the administration will pivot to some other trade related statutes to maintain that pressure. This would bring back high levels of uncertainty and reduce clarity for businesses to spend capital. So we'll be keeping a close eye on this decision, which hopefully evolves sooner rather than later. The last risk I'll discuss is the increasing concerns of the labor market. Unemployment is ticking up a little bit, and hiring is also slowing down and has been slowing down for quite a while. This chart shows 3-month averages of hiring since 1970, and those gray regions represent recession eras. Notice how prior to a recession, hiring often slows down, the chart declines, which makes sense intuitively as businesses are looking to cut costs. When we move to the far right of the chart, post-COVID, the labor market has created what I would call an outlier of slower hiring that did not ultimately result in a recession. Now, the definition of a recession is pretty subjective, right? Some argue that we did have one in 2022, but I would say generally we avoided worst case scenario environment post-COVID. And so we'll be watching, especially if this chart flips negative below zero, that could be an even bigger warning sign for the labor market. And generally, recessions have elevated unemployment. So this will be key in 2026. Moving away from the risks and onto areas we are still constructive on heading into this year, as we still project a positive year for the S&P. The first is the financial sector, which was one of our top picks last year, actually, and remains attractive. We're now in an easing cycle, right? Rates have been coming down and are projected to still come down a little bit here in terms of Fed policy. And with cuts still on the horizon, right, we believe that supports increased deal flow for banks and investment banks, banking activity overall, such as mergers and acquisitions, IPOs, and debt refinancing, where a lot of companies can refinance their old, more expensive debt with new and cheaper debt. These conditions also create greater liquidity and incentives to borrow overall. For banks specifically, borrowing creates loans for them, which are actually assets on their balance sheet, right? Since they earn interest, collect interest on those loans, and the availability of credit overall will be pivotal in terms of spending and loan activity, particularly for small businesses. Lastly, we view the sector as having more room to run in terms of valuations, and it's not too terribly expensive. Smaller banks have historically been the biggest beneficiaries of rate cuts. So we'll be watching that area specifically throughout the year, as these projected conditions could create tailwinds for other rate sensitive sectors as well. The other area we favor is international stocks. Why do we like international stocks? For the past decade, US stocks, particularly technology, have become increasingly expensive. In the 2010s, tech companies were able to finance their growth much, much cheaper than they can today. Not to say we don't believe in those companies continuing to grow, but it's important to acknowledge that the cost of capital is higher, the margin of error is lower, and valuations are elevated, as I showed you earlier. As a result, investors should seek to diversify a little bit more and be more open to investing in global stocks. International stocks have a higher concentration of value stocks, like banks, energies, more mature industrial companies. A lot of these are in the mature phase of their business cycle, meaning they're more likely to return capital to their shareholders in the form of dividends rather than reinvesting those profits back into the business like a higher growth company would, right? And so for context, the S&P 500 has a dividend yield of about 1.1% on average, while the MSCI EAFE index, which we use to track international stocks, particularly developed markets, pays a dividend yield of over 3%. When the dollar is weak, usually more prevalent when short-term interest rates are declining here in the US like they are now, the value of international stocks naturally increases when it's converted back into currency for US-based investors. And so owning stocks in other international markets can potentially lessen that downside if the US dollar continues to lose value because of trade war tensions or we continue to increase the deficit of our country. The weighted average tariff rate in the US is around 15% currently. And so by investing in international markets, additionally, investors gain exposure to companies that operate under different trade agreements from the US, which is a great hedge against that US tariff and policy uncertainty, which may occur due to the Supreme Court ruling this year. One last chart I'll show you has to do with those international stocks. Why do we pay so much attention to the US dollar? Because we view a relationship with a falling dollar and international stocks doing well relative to US in that same period. This chart shows that phenomenon happening since 1975, which was a few years after we hopped off the gold standard and implemented our modern fiat currency system we have today. The gray region represents those periods of a declining dollar, and the purple region depicts rolling 3-year returns of international stocks relative to US. So essentially, when the purple region is positive, that means international stocks are doing better than US stocks in that specific period, and below zero implies international stocks are underperforming US. You can see if we go to the era of around 2010 or after the 2008 recession, that US stocks dominated the markets, particularly growth companies. That's because the Federal Reserve wanted to stimulate the economy as much as they could, kept interest rates low for years. Inflation actually was not that big of an issue in the 2010s, so it was relatively easy and cheap to borrow and easy to grow, especially for a tech company, right? Fast forward to the post-COVID era. Dynamics have completely shifted. Inflation has been a prevalent issue. I hear about it every single day. Interest rates remain elevated relative to the previous decade. Tech stocks have still done well, but again, there's increased pressure to deliver a higher return on investment for those companies, and the margin of error is getting thinner. It doesn't take an expert in this chart to realize that the gray regions often produce a positive purple region, usually synonymous with falling interest rates and has symbolized better performance of international stocks. So history doesn't always repeat itself, as Thomas said, but it can often rhyme, and we use these signals to infer about future expectations. With this chart, and all this is to say that we see a weaker dollar continuing to be a catalyst for international stocks for the foreseeable future. Overall, again, 2025 was a phenomenal year for most asset classes, and now after 3 straight years of 15% gains for the S&P 500, we want to be mindful of the increased risks we face heading into the year. We still foresee a positive 2026, likely single-digit gains, but the path to get there might exhibit some speed bumps or, in Minnesota terms, potholes along the way. As I said, we like the financial sector and international stocks due to those structural tailwinds in place. But at the end of the day, the most important factor for your specific portfolio is an actively risk-managed strategy for the road ahead. Risk management is interpreted differently for everyone based on their specific investments. And so I encourage you to use the themes we use today to prompt and review your allocations with your advisor and make sure it still aligns with your goals. Thank you everyone for listening, and now I'll pass it back to Carl to talk about some important updates regarding tax year 2026.
Perfect. Thank you, Cade. So last year was a pretty big year, a pretty big tax bill that was pushed through on July 4th. And a couple of the key things here for 2026, and then in particular for Minnesota residents as well. So I'm going to kind of cover a gamut of a number of different client situations just to kind of provide some context and some ideas. But if for folks that are still continuing work and not retired, one key thing is going to be to check your pay stubs for the first pay stub of the year versus the last pay stub last year. So from what we've seen from our tax planning is that a lot of the 2026 tax bills, tax benefits have been very fruitful for most folks. However, payroll companies did not implement those expected deductions in 2025, but they are implementing them for 2026. So depending on, if you do your own taxes or if you work with us, one key thing is to make sure that there's not a massive drop in the tax withholding at the beginning part of this year, where you might have to catch up a number of withholdings towards the end of the year. So trying to maintain approximately the same amount of withholding will be key until you do your taxes and find out which of those benefits are most fruitful for you. Second key thing for folks over age 65, one of the promises of past election was to have no tax on Social Security. That one's a little trickier to do. So what they did was they enhanced the senior deduction for folks over age 65, where you're going to get an additional $6,000 added to your standard deduction, so long as your modified adjusted gross income is not over 150. So that way, most of the benefits go towards folks in the lower income tax brackets. Another big thing for Minnesota residents is the increase of the SALT tax deduction. So that's the state and local tax deduction, so that we can deduct our Minnesota income taxes that we pay against our federal. Now it does limit that or phase out back to the $10,000 limit that we had previously if you have over $505,000 of modified adjusted gross income for married folks. But for many folks, it definitely added to the potential deductions and a large tax savings for Minnesota residents. Another key thing on the overtime and the tips, and we've seen this a lot with our firefighter clients, police officers, is and engineers on the overtime. One thing to double check is if your pay stub or your W-2 that you get, if it classifies or itemizes that overtime pay, because you could potentially get a tax deduction for that. But again, most payroll companies did not have time to implement it for 2025. And so that might be difficult and focus on potentially getting that tax deduction. And essentially, let's say you get paid $50 an hour, 1.5 times pay, $75 an hour. It's that extra $25 an hour. That's what will be deductible potentially off your income, so long as your total income is under $300,000. A couple other key things on the charitable side. So charitable gift deduction for itemizers. So if you itemize your tax deduction, essentially for 2026, there's a new floor where the first 0.5% of your income is not deductible, or it essentially carries forward, but essentially not deductible. And so that might limit or reduce some of the itemized deductions that we can get for charitable gifts. That typically limits folks that have significantly larger itemized deductions, massive gifting compared to their taxable income. But for the non-itemizers, so if you just take the standard deduction, the nice thing is that you can gift up to $1,000 to a public charity. It has to be cash, but then you can add that to your standard deduction as well. So keep track of cash gifts to public charities as you head into 2026, even if you're a standard deduction filer. So the pay stubs is one thing to watch. And then another thing to keep an eye out here for 2026. So Minnesota has not voted to conform or align with the federal tax law. And so that might be an issue, probably more so for 2026 versus future years. In the past 2017 tax bill, Minnesota did conform to the federal laws on May 30th, 2019. And then they made it retroactive for the previous year. The summary of this is it might be fruitful for folks to file an extension spring of 2027 for the 2026 tax year. So again, if history doesn't repeat, if it rhymes, It may take a while for Minnesota, especially because they have the elections coming up here, take a while to sit down and actually conform to federal laws. And if that's the case, similar to years past, they made it all retroactive. And so it might be fruitful essentially to wait to make sure that you can get those tax benefits and then file possibly summer of 2027. So we're going to be on the lookout for that, and have a number of connections with the Minnesota CPA organization that's connected with the legislature there. But I just want to give a fair warning. Hopefully they can conform or not conform or vote one way or another sooner than that. However, I just want to give you a heads up that it might be fruitful to essentially wait, so that way you don't have to add back income into your Minnesota tax return compared to your federal. So a little bit of confusion there with these big tax bills, but yeah, hopefully you found that fruitful there for the taxes. And it's looking like we don't have any questions here in the Zoom call, but if you do have questions, feel free to reach out to your advisor, and happy to have more discussions. And for any family members or friends that you think this might be fruitful for, we're going to try to get this posted on YouTube here in the next 2 weeks or so. So feel free to share this link with others. But appreciate you all, and we don't take that responsibility of managing your investments or taxes lightly or for granted, and appreciate everything you've provided for us, and hope to ramp up and keep improving our services for you guys. Thanks so much for joining us. Hope you have a great rest of the day.